Last week, Scott Bessent gave markets a reason to believe the government would defend the bond market and Bitcoin flew. But today, Kevin Warsh reminded investors that the Fed is still actively fighting inflation. That tension matters enormously for Bitcoin. I'm going to tell you why and cover all the other news driving crypto markets here on the Daily Wolf. Let's go. What is up, everybody? Welcome to the Daily Wolf on Yahoo Finance. I am your host, Scott Melker, also known as the Wolf of All Streets. Today is a big day. Everybody was holding their breath, awaiting the words of Kevin Warsh in Jackson Hole, Wyoming. Now, I joked earlier that we should actually be looking for what he doesn't say and not what he does say, because we all know that Kevin Warsh is being purposely tight-lipped, not trying to give very much information, eliminating forward guidance entirely, and trying basically to be as opaque as humanly possible. That's his new strategy. But he did come out rather hawkish, and markets probably are going to take some time to absorb that. And as I said in the intro, we now have this strange push and pull between the Treasury and the Fed. Many were looking for the Treasury and Fed to work together. People view Kevin Warsh as Bessent's guy. Both Bessent and Kevin Warsh were students of Druckenmiller, and Trump probably put them in place so that they would work together to create the ideal financial conditions. But so far, that is not exactly what's happening. So you all remember that last week on August 19th, the Treasury announced that it would at least double its buybacks of older 10 to 30-year government bonds, the maximum increase from $2 billion to $4 billion per operation beginning on September 9th. Now, the Treasury described this as liquidity support for older bonds that trade less efficiently. As I've told you, it's not quantitative easing because it's not money printing to do it. And it's not yield curve control because there's not a specific number that they're going to defend. But either way, it was Bessent coming in and saying that the government has a level of yields on long-term bonds that is not acceptable and that they're willing to do something about it. That sent Bitcoin flying because long-term yields determine mortgage rates, corporate borrowing costs, asset valuations, and of course, the government's own interest bill. We know that the national debt is now over $40 trillion, and that interest bill is the largest line item on the balance sheet. So Bitcoin flew because Bitcoin is supposed to fly when we realize that fiscal and monetary policy are irresponsible, as is our government. So what we had today was an expectation that Warsh would follow in his buddy Bessent's path. So there was a lot of articles saying Bitcoin will or won't go up based on this, and this is the most important comments ever from a Fed chair for Bitcoin. I don't agree with any of that, but I can understand the reason they were saying so, because there were basically two paths that Warsh could take. Warsh could either say, yes, we're going to ease, we're going to lower interest rates, we are going to support the operations here of the Treasury, we want to refinance the debt lower. Of course, none of these are the Fed's business. Those are Treasury problems. Or he could come in hawkish and say we have a strong economy and inflation is still a problem. He basically did the latter. So he says the economy appeared to have strengthened. He pointed out that business investment is growing at its fastest pace since 2021, driven heavily by AI, and S&P profits have risen more than 20% over the past year. Credit spreads remain tight, lending standards are relatively easy, and Warsh said, and I quote, he would be, quote, hard-pressed to describe financial conditions as broadly restrictive. He also pointed out that labor markets remain stable and consistent with full employment, and then hinted that this allows the Fed to concentrate on inflation, with annual PCE at 3.7, 6-month annualized PCE at 4.1%. More than half of the PCE basket has increased by over 3% during the last year. He said, this is where it's hawkish, he said, recent improvements have not meaningfully challenged the underlying inflation trend, and said the 2% target is, quote, firm and fixed. His conclusion was that the Fed must see inflation moving clearly and sufficiently towards 2%. Otherwise, it still has work to do. Of course, he then said he has no crystal ball. There'll be no more forward guidance, all these things. but this was his final quote. "I stand here today committed to a discipline, not to a decision." So he was non-committal, so it doesn't close the door entirely. But right now we have Bessent and Warsh addressing different parts of the same problem, right? Treasury has long-term borrowing costs that cannot be allowed to destabilize the financial system, but the Fed has persistent inflation that cannot be allowed to destabilize the dollar or inflation expectations. So he came in very hawkish. He didn't say he's going to raise rates. I don't think he will, but he certainly indicated that there's no reason to believe that they would cut into an economy right now. And that is not what Bessent wants, right? Bessent wants the Fed to make his job easier by cutting. So very clearly, Bitcoin's rally that we had was not based on the idea that the Fed would turn dovish, right? It was a bet that America's debt burden will eventually force policymakers to control yields and tolerate more inflation, right? Bitcoin goes up when the government is irresponsible, and Warsh really challenged that bet today without destroying it. So we know that Treasury is already demonstrating a willingness to intervene, and Warsh, well, he really has not. So the question for Bitcoin moving forward is which one of those wins? Where does that tension play out? And does Warsh eventually capitulate, do what Trump and Bessent want, and cut rates? Really interesting financial environment right now. I think it's clear that if he's not going to do what Trump and Bessent want him to do, that we will remain in a fiscally dominated environment where the actions of the Treasury will be most prominent. So Warsh obviously made AI central to his economic outlook, talking about it. And one former Bitcoin miner just shows us exactly what that transformation to an AI-driven world looks like. Here you go. Iron shares fall 8% as costly AI transition weighs on earnings. Weakening profitability overshadowed a major milestone in Iron's transformation into an AI cloud provider. So I've told this story over and over and again. It started with Iron. Bitcoin miners are becoming AI data centers. It's more profitable for them to become AI data centers. They're already set up to do it. And Bitcoin mining right now is not profitable at all. It's a perfect storm for them to convert their business and make a lot more money. So listen, at the top line, this looked really good. Iron's AI cloud revenue more than doubled during the quarter to $70.5 million. Their Bitcoin mining revenue was $66.7. So AI now generates 51.4% of Iron's quarterly revenue, the first time that we've seen a tilt in the direction of AI. And we know that trend will continue until Bitcoin mining becomes a rounding error. This is very clear evidence yet that Iron and the other miners I've told you about are exactly what I've said, which is AI data centers that may mine some Bitcoin when it makes sense. So this seems like good news for Iron, right? So why is the stock down? Well, total quarterly revenue fell 5% sequentially to $137.2 million. Adjusted EBITDA dropped 68%, and they recorded a $684 million net loss. Why? Because it's really expensive to become an AI data center and make that transition. Now, that will all clear out eventually, but it should be clear that as much of it as it seems like this is an obvious and easy pivot for these companies to make, it is not. It's going to be expensive and it's going to be difficult. Either way, though, we can stop viewing Bitcoin miners as Bitcoin miners. It's a misnomer. It's not the case. They are AI data centers that will likely mine some Bitcoin. And now, while these crypto native companies are attempting to become AI companies, traditional financial institutions continue moving in the opposite direction, deeper into crypto, and I'm here for it. Charles Schwab adds Solana, Avalanche, Chainlink to crypto platform. This is native Solana, Avalanche, and Chainlink, not ETF or some kind of wrapped institutional exposure. This joins the announcement that we had before that they were offering Bitcoin and Ethereum spot trading. Now, to be clear, you cannot transfer these assets on and off, but you can buy and hold the spot assets on Charles Schwab's platform. Chuck Schwab. This is going to happen in the coming months. And once again, the fees here will be 75 basis points like they are with Bitcoin and Ethereum. So just to put in perspective how big this is, right? It doesn't mean that all these people are going to buy these three very random assets that they've added. But Schwab oversees more than $12 trillion in client assets with approximately 39 million active brokerage accounts. So joining Bitcoin and Ethereum is not the big story for Solana, Avalanche, and Chainlink here. The big story is that it sits alongside customers' stocks, bonds, ETFs, and cash. This makes a crypto allocation far easier for investors who in the past would have had to go open an OKX or a Coinbase account to get exposure. So people are asking why these three. I mean, Solana obviously is the clearest large cap next to Ethereum. They said that Chainlink is an infrastructure connecting blockchains with prices, financial data, and tokenized assets. Avalanche is a bet on institutional networks and customizable blockchain infrastructure. Schwab is effectively taking three established infrastructure plays rather than offering hundreds of speculative tokens. Eventually, this is going to be everything, I would imagine. Obviously not the case yet, but it is a slow rollout that we're seeing from multiple platforms, right? We obviously reported on the fact that Morgan Stanley via E-Trade had opened the doors to their 9 million customers to gain spot exposure to crypto assets as well. So as I've told you before, we have the traditional brokerages and institutions on one side, the crypto natives on the other side, and they're all converging to offer everything to everyone. And it's going to be a very interesting battle to see who wins. Now, to me, this isn't really Charles Schwab trying to gain new customers. This is Charles Schwab trying not to lose customers who want exposure to these assets to other platforms. If you leave Charles Schwab as a customer or take 20% of your assets and go to OKX and buy Bitcoin, that money never comes back, right? Even if you go buy Bitcoin right now, you can't send that Bitcoin back to Charles Schwab. So to me, this is protection. They're making sure that they offer the biggest, most popular assets in their view, and that the customers who want it can at least gain some exposure there without seeing capital flight. I think it's really, really interesting time right now in the industry. And we're going to see only more of this moving into the future. The next story is a really interesting one. Kraken users briefly locked out after a flood of sanctioned crypto transactions. The activity appearing to spread sanctioned funds to trigger account restrictions occurred between August 17th and August 24th. So Kraken basically received roughly 12,000 low-value crypto transfers in that 1 week period. The transactions were between, a few cents and up to maybe just a few dollars. And they came from wallets that Arkham Intelligence had stated belong to HTX Exchange. Now, HTX is subject to UK sanctions and European transaction ban over alleged connections to Russian-linked payment networks. So HTX themselves has disputed this has anything to do with them, that the wallets are inappropriately attributed. That's not the story. That's what happened here. They are sanctioned wallets regardless of where they're coming from. So why would somebody do this? Basically, public blockchains allow anyone to send funds to any valid address. So a customer does not actually have to approve to accept these addresses. So by sending dust, as they call this, from sanctioned wallets, you can basically wildly disrupt an exchange and make things very, very difficult for the individuals you're sending to because they're getting a transaction from a sanctioned wallet, which caused Kraken to obviously have to freeze very temporarily the assets of some legitimate customers that were doing absolutely nothing wrong. Now, they restored this quickly, but what they did here, they identify exchange link customer deposit addresses and then send them all a little bit, and then compliance freezes it. So this becomes a very, very cheap attack vector for these hackers to cause mayhem. Crazy story. And one very final story, how not to invest. We have GTA 6 leaker cashes out of his own meme coin hours before Rockstar's gameplay revealed. You may have seen that somebody was leaking Grand Theft Auto 6 clips and said he was going to release the whole game. And every time he did that, it was tagged with a meme coin while he was earning fees on that meme coin, trying to pump his token by doing it. It was all about a meme token, and then was able to dump a bunch of that on retail, made about $270,000, reminding you, don't just buy an unofficial meme coin because it has a cool name that seems to be linked to something. These are not real. They're used to extract value, and you will eventually lose money and get rug pulled. That's all we got today for the week. I will be back on Monday with the next Daily Wolf. Peace.